Okay, good morning, everyone, and welcome to this Connect University session on equity investment funds. I am Raquel Chivitarial, and I will be moderating this session. Before we start, I just want to share a few words on the Connect University sessions in general. They are the flagship initiative of DigiConnect, which aim to update both the EU staff and the general public about the latest digital trends and policies. Today, we'll talk about equity investment funds, as I said, and more particularly about how they can deliver the Commission's digital policy with one specific example. But I leave the details to my colleague Julien Bollati, who will introduce the session in a moment. Before that, I just want to make sure that all of you are connected via Slido today, because this is where you can write or ask your questions. Know that there will be a dedicated Q&A moment at the end of the session to answer all of the questions you have. Please also note that the recording for this session will be available as of next week on the Digital EU channel on YouTube and the slides on the Futurium platform, but links will be added in the chat. Now we'll quickly introduce our speakers before we move on to their presentations. So today, as I said, we will be in the presence of Mr. Julien Bollati. He's a program officer in Unit B5 of DigiConnect at the European Commission. We will also be in the presence of Mr. Yves Speckert, CEO Director at Emergy Capital Markets. Then we'll be also in the presence of Ms. Natalia Sutugina, Managing Director at Cube Infrastructure Managers, and Mr. Mustafa Demir, Investment Director at Cube Infrastructure Managers as well. Now we'll leave the floor to Julien Bollati, my colleague, for the introduction of this session. Julien, the floor is yours.
Thank you very much, Raquel. Good morning to everybody. So the EU has established an ambitious target under the Digital Decade Policy Program 2030. By 2030, all European households should be served by a gigabit network, and all populated areas covered by a next-generation wireless network, equivalent at least to 5G standalone. Achieving this goal will require substantial investment from the private sector, as well as support from public funding, including from EU programs such as the Connecting Europe facility, so the digital strand of CEF, and the Recovery and Resilience facility. The total investment needs have been estimated to exceed 200 billion euros, depending on the technical implementation options considered. And not only this is a very large amount, but the Monti report has clearly depicted a Europe at a crossroad that needs a shock therapy to boost its competitiveness. Finding the resources for all the political priorities that we are facing today, including defense, greening our economy, is really a challenge. In this context, where a reflection on the programming period 2028 to 2035, for which the Commission should make its proposal essentially in the next 12 months, it is crucial to make a stock take of all the experience with different financing options. This morning, we will give particular attention to one that has the benefit of capturing market forces to deliver EU policies, and doing so with a limited impact on the EU resources. The agenda foresees an introduction, as it was already said by Yves Speckert, on the general presentation of equity funds, and he will also share an insight of work that is being done in the EU to continue the experience. And then we will have a second part of the session focusing on a specific program, a specific fund, the Connecting Europe Broadband Fund, and the lessons learned from this experience. So I will conclude already this very short presentation, and I propose that we go directly into the topic of today. Thank you.
Thank you very much, Julien, for this introduction. I think we can, as you said, jump into the presentation of Mr. Yves Speckert for the Equity Infrastructure Fund. So Yves, the floor is yours.
Thank you very much, Julia and Rachel. Well, good to be with you today. And indeed, I have the turn for the easy task, let's say, to introduce what is actually equity infrastructure funds and the universe, let's say, of equity infrastructure funds, which is a large universe. I mean, it is certainly a growing, asset class, and I'm going to tell you why. So maybe we can go to the objectives, which is the next slide. And today, what I would like to share with you is defining what is the universe of infrastructure funds, private versus, impact fund. Why infrastructure as an asset class, could be attractive as an investment. I'm going to provide 2 case studies of good practice or well-managed infrastructure fund. One is called a Digital Bridge, which is a purely private, very large asset manager who is managing 3 funds at the moment and more. And the second one is more like a impact, oriented, which is called Convergence Partner. And eventually, I will have the pleasure to really introducing in a few slides the Digital Leap Fund, which is a EU/EIB initiative, which is a 500 million fund that is being structured indeed by the Commission, and where we hope to attract both private LPs as well as DFI and EU first loss equity. And then I will lead to the conclusion. So thank you very much, Rachel. Maybe next slide, and I will start right away with the infrastructure as an asset class. So I think first we need to define what is the universe of infrastructure assets. As you can see, basically, there are 2 types really of infrastructure assets. One is actually more economic infrastructure, meaning that those are like offtake or cash flow generating assets, such as transport. Of course, when you set up, for instance, an airport or a port, you usually like lease, some of the different slots where basically airlines or shipping, are using basically those infrastructure, and out of that you derive some revenues. The second one is utilities, such as energy, storage, water, or maybe waste treatments. All of these are also like cash flow generating assets. Even in waste, for instance, you use the volume of waste that you are treating, and per meter cube of waste, done, you derive a certain revenues. The third one, which does interest us, especially with the DLF fund, communication infrastructure fund, which is really like a rising, I would say, asset class. And those are the funds that invest in hard infrastructure and could be also in soft and service, infrastructure, such as transmission, first mile, fiber networks, submarine cables, towers, to relay basically the signal for mobile operators, satellite, data centers, etc., etc. It's a large universe, and that's the one that we're going to develop in the third part of this presentation. And then eventually, I mean, renewable energy could be part of utilities, but it's becoming an asset class in itself, because as we know, the world is now really gearing up to a decarbonization. And so there is a huge worldwide effort, both from the private sector and the public utilities, to make a transition towards clean energy. So the level of deployment now of renewable energy is enormous. And there is a strong backup by asset manager, by shareholders, to really back up 20-25% of investment in those kind of assets. The second is social infrastructure. Those are very much needed. It's part of the fabric of our life. You need to have school and education facilities, both in the private and public sectors. Healthcare facilities, the buildup of hospitals, senior homes, etc. And also, of course, public buildings, prisons, stadium. I mean, all those infrastructure that are part of, let's say, society. Those needs to be upgraded, sometimes to be destructed, to rebuild, other ones, and those requires investments. And there are now more and more, economic models that could be done on this, even though the return on investment, I would say, of social infrastructure tends to be lower from economic infrastructure. Now, very important, and that could have been a slide in itself, because the point below, which is the value proposition of infrastructure as an asset class is quite important. And I don't know if you can read it readily, but I will go through each of those because those are important. Usually, when you build up an investment portfolio, you try to diversify your portfolio. Remember, basic rules of corporate finance, try to diversify the risk of your portfolio. Well, it happens that infrastructure as an asset class is a fantastic diversifier of a portfolio. And that for the following reason that are stated there, is that A, usually those are fixed assets that are being put on the ground that have like a long life cycle. Remember that when you put infrastructure on the ground, it's usually for at least a lifespan of 10, 15, sometimes 20, 25 to 30 years. So those are long-term fixed assets which are on the ground, which represent, of course, a very natural hedge against inflation. So even if you have an economic crisis like 2009, well, your power or hydropower plant is still in the ground, is still generating electricity. And so that is the robustness of a physical infrastructure, is that you have A, the value of the assets which are being built on the EPC contract, and two, you have also a cash flow generating assets. Now that is a very important point, is that most of the assets that we're talking about are usually backed up by what we call an offtake agreement, or in the energy sector, a power purchasing agreement. So those are long-term, predictable flux of cash flows, which basically reimburse for all the debt or even the equity investors who have put a lot of money to build up those infrastructure. So indeed, infrastructure as an asset class has like a long maturity time, 10 to 15 years. You need to be very patient, but those are very solid assets. I would say also that if you have a strong offtake or PPA agreement, the default rates of those kind of operations are very low. So those are quite secure type of investments. Also very important dimension is that those are socially and more environmentally responsible investing. So that is very attractive. Is an additional dimension, is that there is an ESG now component to most of those things. For instance, if you build 150 megawatt, renewable energy solar plant, of course, you are contributing to mitigating the global warming. So those are assets that are quite attractive because there is the value of the assets, there is the offtake agreement, plus the ESG dimension. So those could be really combined nicely. One last thing is that once you have done the CapEx, which is the capital expenditure to set up actually the assets, you have low operating costs. So those are almost, I would say, assets that run by themselves. You have relatively low, what we call variable cost or OPEX cost, and the rest is simply a setup contract for 10 or 15 years. So the cash flow are very predictable, which again makes it, quite attractive. Now, what is the downside? I mean, all those are, quite good and attractive features. I would say the only downside is that you need to stay the course. I would say this is like patient capital, and most of those assets, you really have, I would say, the return on investment only at the end of the investment cycle when you do the trade sale of the assets. So you need to hold sometime those assets in a fund, for instance, for at least 10 to 12 years. Knowing that some industries like the telecommunication industry or the digital industries have sometimes shorter cycle. Why is that? Because you have maybe a more liquid market and you have more consolidation play. For instance, I give you an example. If we are, for instance, through the DLF fund, we are probably planning to set up, invest basically as an equity junior partner into a number of data centers. Data centers are those very important things, and Africa has very little of them. And you may have actually players who wants to consolidate and build a portfolio of data centers. So if you invest in a data center in Nigeria, in South Africa, in Egypt, you can have a player that would be really interested to consolidate those assets. And therefore, the attractiveness of those good assets are quite high. And therefore, you can maybe do the exit before the end of the maturity of that asset class. Voila. Next. I think that we take maybe some questions afterwards. I wanted also to describe a little bit, what is the size of this market. And I think, and sorry, I mean, it's difficult to read, but you can see that there was like a lot of different colors with like a number in it. So for instance, if you look at the year 2022, you can see that the first one, which is Macquarie, which is one of the largest, fund managers specialized in infrastructure, has managed to capture and invest $86 billion just for the year 2022. And this is actually, then you have like the top 10 basically largest infrastructure funds, which have over the last 5 years up till 2022 managed to raise a total of 950 billion. So it is even like a multiple from Julian's figure. It is actually a very large universe, and you have specialized investment funds and fund managers who raise a lot of money for all the reasons that I've said before. Is that it is in a portfolio, let's say, of a pension fund or a portfolio of a large private asset manager. They always have a pocket for infrastructure investments. So this is attractive. There is a lot of liquidity around, and infrastructure is one of those, attractive assets. So what are the largest, let's say, asset managers specialized in infrastructure? The biggest one is Macquarie, which is based in Australia. You have Brookfield and GIP, which are based in the USA. And then you have actually the first European one, which is called Equity, which is based in Sweden, which managed to raise, nevertheless, I think it was 43 billion, back in 2022. So those are really large asset managers who are going really for the returns. Remember that those one have basically a lot of responsibilities vis-a-vis their shareholders. So they want to achieve, minimum, I would say, net IRR between 10 and 15%. IRR is internal rate of return, which is a measure of the return on investment. Again, those are long life cycles, and those are, a diversifier. I just wanted maybe to say a word still on that slide on the exit. People may ask, but how do you sell such giant assets? How do you sell a utility? And indeed, one has to say that infrastructure assets are not as liquid as, of course, securities, bonds, green bonds, or other type of assets. So where do you sell? Where is the market when you can actually sell those assets? Well, it happens that actually there is always an exit. I give you an example, for instance, of transport or like toll roads. I'm myself, a director in one of the funds, with Rothschild. We do transport and toll roads and parking, basically mostly in Europe. And basically, those assets are quite liquid because once you have basically invested in the road and you have proven that through the toll fees that you're generating on the toll road, well, private sector or public sectors is quite interested to buy those assets once they have been amortized, for a certain place. So therefore you can sell them after 6, 7, 8, 10 years, and basically with a premium. And this is where you realize basically your return on investment. Let's say if you have also in the data center example that I gave, you have a consolidator, they are ready to buy the assets which has proven to be worth for a price which is very attractive. And you have already enjoyed, of course, all the cash flow during the lifetime of the assets. So that's how exit is happening. Next slide, please. Okay, so you may ask yourself, who are the biggest investors? And this is a question we need to ask ourselves for the Digital Leap Fund, of course, on the private and also the public side. Well, it happens that infrastructure being a very solid cash flow generating and inflation hedge, portfolio diversifier, it's no surprise that the big institutional investors are the biggest one, to make those investments. So in general, Preqin, which is a research company, has listed about 800 investors in infrastructure funds, and they came with, let's say, the public pension sector pension funds, such as the Canadian Public Pension Fund, to give an example. Well, they usually put about almost a quarter, 23% of all the investment. Private pension fund, which are the pension funds set up by companies, KPMG, British Railways, whatever, Air France, they invest about 13%. Then there is the foundation, the endowment, the superannuation, which is like an employee scheme, of pension. They invest respectively, 8 and 7%. Insurance company is a big investors. For instance, the CEBF fund, which is going to be talked about, they managed to attract some insurance company. And at the end, sovereign wealth funds, such as the North Fund in Norway, we know that they have enormous amount of money. They always put, a pocket of their investments into those kind of assets. And more, I would say that on an ad hoc basis, I would say that public investors or multilateral investors like the EU, like maybe through the EIF, the European Investment Fund, are also investing into infrastructure assets. So that's important. There is demand, there is appetite for those kind of assets, but it comes from very specific type of institutional segments. Thank you. Next one. So I just wanted to maybe emphasize very quickly, maybe to contrast two different kind of equity, infrastructure fund managers and funds. The first one called Digital Bridge is a purely private, purely, I would say, IRR focused shareholder, responding focused type of fund manager. And the second one, Convergence Partners, has like a slightly more development or impact, focus. So Digital Bridge today, and both examples are in the digital infrastructure, because I will talk afterwards on DLF. So I will try to differentiate how those different players, may complement each other. Digital Bridge is a global fund manager specialized in digital infrastructure, which is based in Florida. They currently manage 84 billion, which is a very large amount of money. They've been there for 25 years, and they have 45 companies in their portfolio. Now, if you do the ratio of 84 billion divided by 45, you can see that the ticket that they're investing is very, very large. And sometimes it could go into the hundreds of millions into a specific company. So they tend to really focus on taking very often majority equity. That's very important, is that they have strong teams, technical teams that allows to manage or co-manage, the assets. So they have enough resilience, to do that. They are worldwide. We know that through, for instance, the third fund, they invest also in Africa, which is interesting. And their offices are all over the world, from Los Angeles, New York, Singapore, even Luxembourg and Madrid. Their focus area is both, I would say, in hard infrastructure, physical infrastructure assets like data center, fiber networks, cellular towers, edge infrastructure, but they do also more and more into services. So for instance, when they invest into a data center, they tend to go also for all the services and to really try to grow the service part of the assets. And more, as you can see, especially in digital assets, the frontier between physical assets and service is blurred. And so you need to have really like a dual approach. Next slide, please. Thank you. So just to give you a sense, we won't go into each of those, but I think the third one might be actually interesting. You can see that, in their progression, almost every 2 years, they are launching like a $4 to $8 billion, fund. That's pretty amazing. I've been into the fund industry now for 15 years, and I tell you, to raise 50 million, on the market is very difficult. So this means that Digital Bridge must have a super efficient, like a marketing and I would say distribution team. Those are typically fund managers who have a list of 10,000, 20,000 LPs, limited partners. So those are potential investors, and they are very, very, very good at raising money. I give you another example. I mean, if a fund is really successful and a fund manager has shown to be really very good at what they do and having a strong track record, usually most of the funds are what we call oversubscribed. I give you an example, so I won't give the name of the other things, but I'm also on the board of a Spanish private equity fund. Every 4 years, they raise 350 million for the market to invest into SMEs, Spanish SMEs. They have such a track record. I mean, right now their IRR is about 30%, 30 to 35% per year, that they attract usually 1 to 2 billion of oversubscription for their final closing of 350 million. So you have those lucky fund managers who have such a LP, such track record, that whenever they launch a fund, like for instance, Digital Partner 3, which was more challenging, 3.3, it was mostly oriented both on Canada, I would say mature economies, as well as Asia, Africa, and the Middle East. So it was the first time, well, they did a little bit Asia before, but the first time they venture into the Middle East and Africa. Well, they managed actually to raise almost 3.5 billion on that. And so this is the strength, I would say, of those private, well-owned, well-oiled, basically, fund manager houses, is that they have a huge capacity to raise money. And this is why we're seeing such gigantic funds, which usually are oversubscribed. Funny enough, I mean, they put a setting, let's say, of 4 billion, and sometimes, they receive about 6 billion of commitments. So they can pick and choose also the investors they have. Maybe next one, I'm going to contrast this with a convergence partner, which is a bit closer to what we're talking about here, probably with the EU. We know that the EIB and I think the EU, a lot of the DFI have invested into convergence partners. So it is an investment firm, focused on accelerating communication access and ECT infrastructure development in Africa. So they are very focused on Africa, which is a more risky, clearly a market or geographical area. And they seek to acquire majority or minority stakes in companies to make impact investment in digital infrastructure opportunities. So two features here that are very different from Digital Bridge is that they invest in Africa specifically. They are very focused on one geographical unit, which of course has its own specificity, huge growth, and I'm going to come back to that, but at the same time, higher risk. Because of course, there is more political turbulence, there is political foreign exchange risk, etc., etc. So one needs to really manage very well, I would say, the risk component of those assets. Next, please. And now we're going to show a few of the funds that they have done. How am I doing on time? Still good. So Convergence Partners started with the Fund 1, which was focused really on telecom, media, and telecommunication. It was a smaller fund, which was followed then by Fund 2, Convergence Partners Communication, which has 200 million, worth of assets. And now Fund 3, which was done relatively recently, 4 years ago, 2020, and they raised 3.38 billion, almost exactly the same figure as Digital Bridge. So not bad, because Digital Bridge was, Fund 3 was focused on the whole world, on very large tickets. And frankly, the fact that Convergence Partners managed to raise almost 3.5 billion to invest just in digital infrastructure in Africa, well done. And this shows that they have faith and that actually the market of Africa can take, those kind of figures. So I think this is like a good news, I would say, for the Digital Leap Fund. And so in general, I can think about 4 or 5 other names, which are very similar, which are development, impact focus infrastructure funds, such as African Infrastructure Investment Fund, AIM. You have another one, what was the name? No, it escaped a little bit my mind. Africa Invest, yes, which is investing as well. Remember that, for instance, you have also Climate Investor One, which was an initiative from FMO, which was followed up, by EIB, a different DFI. They managed to raise over 1 billion worth of assets to invest mostly into energy, renewable energy, and let's say climate mitigating type of assets. They have headquarters in Cape Town, and you can see that actually, sorry about that. And you can see that basically those funds, managed to raise, quite a few assets, specializing in Africa, which is really like a tough market, which is like a higher risk. Next, please. Yes. So when we talk about the market, basically here you have just a representation of what is the sub-Saharan Africa broadband market size. And this was one of the research that we have done for the Digital Leap Fund to demonstrate that actually there is a huge potential. If you look on the right-hand side, it's relatively small, but if you look at the right-hand side and you look at, for instance, the middle one, there is actually the increase in what we call broadband, connectivity. You can see there is a number that today there is 87 million people which are being connected to broadband connectivity. And between now and 2030, there will be almost double of that, going to 438 million. So those are all paying customers for broadband connectivity. And you can see that, just a single increase in population, from 500 million to about 2 billion people in Africa, with like a growing middle class, makes it a very attractive case. Of course, you need to pick up, your operators, you need to pick up the right countries, you need to mitigate the risk of the countries, etc. On the left-hand side, you can see all the area in pink are the ones where you have actually a lower than 50% connectivity in internet penetration. So you can see the potential. I mean, today in Europe, we have almost 98% of penetration of internet. There is ubiquity everywhere. Africa, there is huge actually potential for upscaling, and a huge work that needs to be done because those assets need to be laid out. Remember also that Africa is huge. You can put China, United States, in the whole of Europe and India, basically in the 30 million kilometers square. So setting up, assets in Africa requires quite a lot of investments because those are very large territories when you need to put a lot of cells and towers to be able to do a coverage, let's say, of 4G or 5G networks and to provide the connectivity. So physical infrastructure are important. Those are large investments and they require to have further investment. And this leads me now to the last leg of my presentation. Next slide, please. I just wanted to very briefly share with you actually a big initiative which is being done, with jointly with INPA, a team at the EU and also the EIB as a fund sponsor. We are working on what we call the Digital Leap Fund, which is indeed like a digital infrastructure fund, which is aiming to raise 500 million worth of equity investments in different layers, let's say tiers of or tranche, if you like, of investors, from basically junior investors. And this is one of the big specificity is that there will be actually two features in this fund. One is that there will be a component of what we call a junior equity or first loss, which allows to venture into assets, into countries, into segments basically of the digital infrastructure space, which are lesser invested by the convergence partner, by Digital Bridge or other. Okay, meaning that if there is a loss on that asset, it's going to be assumed by the junior investment tranche. Then there is a subordinate equity tranche and then a senior tranche, which is reserved for the private investors. And so the goal, very much like the CEBF fund, which was focused on Europe, is to raise actually money to invest in equity, shareholder capital, usually in minority shares, of several operators operating in different segments. And maybe I would like to focus, just very briefly share the segments. Next slide, please. And yes, one very important thing is that this is both a market-driven fund and also a policy-driven fund, is that Europe has strong beliefs that cybersecurity and also trusted vendors are very important ethical and policy features. And therefore, this fund is going to implement actually those key values or those key policy drivers onto the fund. And those are summarized in the top. Global gateway, of course, this is part of the global gateway strategy of Europe. Trusted vendors and cybersecurity are going to be very important, and also the respect of ESG and EE. I'll give you an example of the ESG dimension. All those tower companies or those towers assets that you find, in Africa or in Europe, many times in Africa, they are being powered through diesel thermic generators, which of course are very polluting, but they're so extremely expensive to run because the cost of oil is very important. The goal would be actually to invest only in tower companies who substitute that with solar or other means of renewable energy. So try to have also the most sustainable type of assets to be deployed, on the ground. Okay. The market segments, we're getting down to that, but basically it will be a digital growth engine, mobile. I think there's a huge uptake of mobile, both in Africa, Latin America, and Southeast Asia. Fixed broadband, because remember that for the larger gigabytes, basically of consumption, fixed networks are still very, very important. And so possibly there is an opening towards services, the fintech that could be plugged in, onto the service side of the data centers, etc. The capital structure, I have already mentioned the first loss tranche. I think it's important to remind that we want this to be a bankable fund, which is extending the broadband connectivity, but not at the cost of the return on investments. So we have a targeted, net IR between 12 and 14%. And that is totally achievable given actually the high growth, of the market, which is going to be diversified. It's not only Africa, but we're talking about the near region, Latin America, and possibly also Southeast Asia. Next slide, please. Yes, I mean, I won't go into all the details because this is getting really, really technical, but I just wanted to overall say that the DLF fund is going to consider, and of course the fund manager will have a strong say in the way they are building up the network, but they will consider, like fixed digital assets going from what we call the first mile to the mid mile to the last mile. Okay, so in telecom, basically, the first mile is very important. It's like the point of entry through submarine cables and fiber optic networks, where you can distribute very high capacity transmission of communication signals. And those are being disseminated in the main cities, usually like port cities. And there is still a lot of assets that needs to be built up, in that respect, especially in Central Africa. I'll give you an example. If you go to Congo, that whole area, Congo has 100 million, inhabitants. There is no POP, there is no point of presence, basically, of submarine cables linking Congo. So you've got 100 million people, for instance, all the inhabitants of Kinshasa, who have a delay because they need to rely on other cables that are elsewhere to be able, to look at Netflix, to receive their things, or to do like corporate communication. So those needs to be developed. MNO, 4G and 5G networks, this is like a big battleground because, as you know, there are different suppliers from China, from America, from Europe, and there we want also to apply the trusted vendors, meaning that, make sure that all those 4G and 5G networks are going to be deployed in total securities with strong sovereignty on those kind of assets. Data centers is booming. For instance, in Africa, only 5% of all the data processing is being done with data center based in Africa. So this means that they all depends on data centers that are based in America, in Europe, in China, in other places. So there is a big need, pending demand for data centers being built up there. Tower companies, as I said, and also Tesco, very interesting assets. Tesco is telecom and energy service companies. So you have the blending of basically those renewable, energy companies who can implement or help work with the telecom operators to implement more sustainable type of assets. And eventually, that's what we call the last mile. It's like fiber to the home, it's fiber to the office. It's one LAN and fiber optic networks which can go to the last mile, meaning the residential or the commercial area. Those are roughly, the 6, digital infrastructure. Again, the final portfolio will be largely decided by the private fund manager who is going to manage this fund. Next one. Yeah, that is interesting too, is that we had done several task force, with the DFI to try to see what is kind of the sweet spot where the DLF fund would be able to make investments where other funds are not doing investments. You remember digital bridge funds? The average, investment is between 200 and sometimes 500 million. Those are very large, investments. Convergence partners, they have also relatively large ticket, but they can go into lower ticket. CEBF funds, I think we're going to have the presentation very soon, is going to talk about their size of assets. What is interesting is that most of the DFI usually do investment between, let's say, 15 to 50 million, but they don't go lower. So some of those assets that are a bit more risky, but are also very attractive, from 5 to 15 million could be a sweet spot. Some of the larger assets like submarine cables would require to have investment up to like 50 million. Those are the range of investment that would be made. Next, and I'm going to conclude on this. Just as a conclusion, infrastructure funds, really represent a vehicle by which an investors, or what we call limited partners, can invest in a solid, decorrelated asset class, from other asset class with a longer maturity and patience with regard to exit. So infrastructure does offer very attractive returns. They have a long-term predictable cash flows. And I would say the infrastructure assets could be a very powerful investment portfolio diversification source. But the downside is that one needs to be very patient with the exit, as infrastructure assets are not liquid in essence. So the exit strategy is very important in evaluating the fund managers and the portfolio approach. Voila, this is what I had to say about the infrastructure funds fund. I hope I didn't take too much of time. And over to you, Rachel. Thank you.
Thank you so much, Yves. So normally we have our Q&A sessions at the end of the sessions, but in this case, Yves, I believe you need to leave before the end of the session. So may
Yes,
I please,
indeed.
we received 3 questions on your presentation. So may I please ask them to you now, if you don't mind, so we can solve them. Okay. So the first one is Chinese and other non-EU countries have different rules when it comes to direct infra investment. Does this still apply to them investing in private funds? If you wanted to repeat. Okay.
Sure. Maybe I will answer very shortly to each of them as we go. Yes, indeed. I mean, if you go to Africa today, you can see that there's a lot of Chinese investments, which I would say plays with very, very different rules than, let's say, US or European investment. They usually invest in hard assets, which are being tied to other contracts, let's say in mineration or critical raw materials. And they very often, most of those assets are subsidized. So that's one big difference, is that, private funds, they work by themselves. They raise money, they invest the money, and they basically get a return on investment on the merit of the asset class that they're investing into, or the operators that are investing into. I cannot generalize, because of course there is a private market in China. China is a huge market. I don't want to simplify things, but in general, especially in hard transport, bridges, telecom, there is always hidden subsidies and other practices which are behind this. This is not to say that, let's say, an asset manager which is based in Shanghai would not actually invest, or through also Asian, development funds, they would not invest in a regular manner into infrastructure funds. So those are two separate things. One is a geopolitical, and the other one is private investment. Yeah, I hope this responded to the question. Rachel?
Great. Thank you so much. So the second question is this funding system in the interest of citizens, or is it a way to disclose markets to privates that are hungry for investment opportunities to satisfy their capital growth needs?
Okay, does this apply to the DLF fund, or it applies to the infrastructure fund in general?
And unfortunately, it is not precise in the question. So,
okay, could you repeat one more time the question?
Repeat, yes,
Yeah.
of course. Is this funding system in the interest of citizens, or is it a way to disclose markets to privates that are hungry for investment opportunities to satisfy their capital growth needs?
I would say both. I mean, frankly, I don't want to create a dichotomy there, because, I mean, if today you invest in a long-term, let's say, solar PV plant, which is going to substitute maybe a thermic plant, this is clearly in the interest of society. It's an interest of the local community who doesn't have a polluting plant, around, and it provides you with a clean energy source. So that is good for society. At the same time, of course, those kind of assets, they have offtake agreement, they have power purchasing agreement, and they produce cash flow, which needs to feed actually a return on investment on the investors. I mean, remember that Convergence Partner, when they raised, 3 billion, for a fund, they just don't do that for fun, but for the fund LPs. So they want to have a return on investments for the LPs. So everybody needs to have a return. Otherwise, simply the capital would go to other assets. So yes, you need to have a capitalistic return on investments, but I would say that the direction that most of those infrastructure assets are taking are going towards more ESG and more, I would say, societal, return, as well as, like a return on investment. Yes.
Great, thank you so much. And then the last question for you before we let you go. So the EU, has supported critical infrastructure through various schemes. Does this apply to private infrastructure funds?
Yes, there is maybe two dimensions in that. And I think CEBF would be able to respond much better to that, because this is a good example of, let's say, a policy-driven fund applying to Europe, and I think that I would like to leave the floor there. But yes, I would say that maybe the difference of maybe EU funded funds is that it will always have a policy driven dimension. It will have a global gateway, driven dimensions. And at the same time, we want to run this as a normal fund, almost quasi a normal fund, meaning that we will hire actually private fund managers who is going to have a lot of latitude in the way they're going to choose and manage the portfolio of assets. Because at the end, running a fund is a métier. This is like a very serious thing. You have shareholders above you. You need to do reporting. You need to justify why you chose those assets. So therefore, there is a lot of latitude that is given to the fund manager. And I just wanted to emphasize that this is the direction that the Digital Leap Fund is taking. We're working with the EIB, who has invested in 90, infrastructure funds. So they have a lot of experience in doing that. And we're going to work with them to choose actually the right, to do like a beauty contest and to choose the right fund managers to both provide a return on investment and also meet some of the policy targets of the EU. And I will stop there. Thank you very much.
Thank you so much, Yves. So now we will let you go, and we will continue and proceed with the session. So for the rest of the speakers,
I'm going to stay to hear the
stay.
next presentation, but
Okay.
I will have to go at around 11:15. Yes, thank you very much.
Great,
Cheers.
Yves, thank you. So as I was saying, we'll proceed with the session. For the rest of the speakers, the questions will be at the very end, not after your presentation. So we'll just move on from one to another. So now we will move on to the presentations on the Connecting Europe Broadband Fund, the CEBF. We'll first start with one with Julien, and then the two last speakers. Just a quick reminder before we move on. So, as you know, you can ask your questions via Slido, so don't forget to ask them there if you have any. And as I said, we'll answer them at the end. So, Julien, now the floor is yours for the first part of this presentation.
Thank you very much. You can go maybe already to the next one. André Gide, a French Nobel Prize for Literature, said, "Man cannot discover new oceans unless he has the courage to lose sight of the shore." In this segment of the session, I will briefly describe how Connecting Europe Broadband Facility, which was a very innovative way of providing EU finance to connectivity, became a reality. I will start with a brief overview of how the use of financial instruments at the Commission evolved until the time it was decided to create CEBF, then describe the objectives that DG Connect wanted to achieve, and see what were the actual challenges in setting up the fund, and conclude with a small overview of the results so far from our perspective. Next slide, please. The financial regulation of the EU budget allows a number of options to implement the financial programs. The large majority of financial aid to third parties come in the form of grants, so subsidies. However, other methods are allowed, including giving loans, investing equity, or issuing guarantees. These three are put under the umbrella term financial instruments. So in the EU jargon, financial instrument is something much broader than what would be understood by a regular person or somebody working in the financial sector, which would be more specific monetary contract, such as a bond or a stock. So the financial instruments have been historically used largely for shared management programs, so where the member states or regions are actually in the lead of the implementation of the programs or outside of the EU. Next slide, please. And next slide, please. So until 2006, the use of financial instruments were really experimental. I think that I would say that the first heights in the use of financial instruments were reached in the 2007-2013 programming period. At that time, about 1.3 of the overall EU budget resources went to financial instruments. As I've said here, we will look really only at the ones that were managed centrally at the Commission level. But just for comparison, of the 21 financial instruments created in this period, 2007-2013, 11 were created by DG NEAR or DG DevCo, what is now INTPA, so for outside of the EU, and they accounted for 11 on 21 funds. And these accounted for 5.5 billion of euros in comparison to the 16 that were invested at the cohesion and regional level. In this slide, you will see some of the main initiatives in the different sector. For the infrastructure, at that time, we had an equity fund, the Margaret Fund, which was a very breakthrough for the time, and also giving an inspiration to what was later on the structure of the CEBF. And it also somehow also invested in the digital sector with an investment in the Ella-Link project. What was done also in that period was the creation of the LGTT, Loan Guarantee for TEN-T Transport. It was a guarantee scheme to cover the ramp-up risk of new rail and road projects. After the LGTT, the experience was expanded with the project bond initiative, which was covering transport, energy, and digital. And this was already starting to evolve into the Connecting Europe facility program covering the three sectors. Next slide, please. By the time we reached the 2014-2020 program, we saw a new and significant emphasis on the use of financial instruments. Everybody wanted to use them, and we saw several new instruments and new topics coming to the picture. For example, we had also funds for the cultural and creative sectors. We had student loan guarantees. We had many new initiatives. For the infrastructure sector, there was a common debt guarantee that was created, the CEF debt instrument, which was an expansion of the project bond initiative. So really expanding the cases that were covered by the guarantee and really a generalization of the scheme. However, at the time, there was this debt and equity platform concept, so that it was allowing using the two routes. So there was also the possibility to use an equity to create an equity financial instruments, and that's something that was considered soon after the beginning of the programming period. Next slide, please. When considering this fund, the CEBF, an equity product, the EU strategy for broadband was defined by the Digital Agenda for Europe. This was set in 2010, and it was advocating for ensuring by 2020 universal broadband coverage with the internet speed of at least 30 megabytes per second. And the second part of the strategy was to have, over time, foster the development and take-up of next-generation access networks, which was of internet speeds above 100 megabits per second. So this agenda was targeting 2020, and so soon after we had a new strategy. So this was finalized in 2022. And it was the Europe's digital decade. Now we had new targets, as I mentioned in my introduction. By 2030, the objective is to have all European households served by gigabit networks and all populated areas covered by next generation wireless high-speed networks with a capacity equivalent to 5G. Next slide, please. So in 2014-15, when the fund was in its still as an idea, the prevailing telecom market structure and the regulatory environment in Europe was giving incumbent operators natural incentives to continue harvesting their copper network. So they had no real incentive to invest heavily as long as no alternative operators challenged them. So the EU took specific initiative to foster open access networks and support alternative operators. And this indeed started to become a reality, with telecom players more and more relying on the infrastructure mutualized, so sharing agreements and open access networks, so that the operators would start competing primarily on the service layer rather than infrastructure. However, there was always a reluctance from institutional investors and long-term funds to substantially invest in greenfield fiber to the home infrastructure. Beyond the traditional risk of greenfield projects, so the fact that there are no cash and yield producing assets as brownfield, so there was also an additional risk that these projects for this project, there is also a lack of visibility of the revenue ramp up, and also a strong sensitivity of the return to the penetration, to the market penetration speed. So a lot of uncertainty for investors, and that's something that was really scaring away investors. At that time, the Connecting Europe facility also had a very little envelope that could be dedicated to the broadband sector. At the time, CEF was mostly focusing on DSIs, digital service infrastructures, and for this reason, the grants were mostly left for the shared programs, in particular the cohesion funds. What it was decided therefore was to maximize the impact of the envelope by creating a financial instrument. Next slide, please. The European Commission asked the European Investment Bank to help design an equity fund. This equity fund was designed to be a multi-layered fund where the Commission and the European Fund for Strategic Investments, the FC Fund, also at the time known as the Juncker Plan and the Juncker Fund, they both invested as subordinated in the subordinated layers, so that in the waterfall process of the cash flow, these two investors would absorb some of the potential losses. Another big upside of this structure is that senior investors are, as we just said, protected. They would be more protected, but also another important aspect is that the net asset value of the investment for the senior investment would be positive already from the beginning. This is also quite important for these LPs, for these investors, that on their book they already have positive net asset value from the beginning. And this is never the case for greenfield projects, because there is the initial implementation phase where the assets are still being developed and they do not produce any yield yet. So very important aspect of the design. Next slide, please. As it was already presented before, the challenge is really to reconcile the two different objectives and perspectives in this type of funds. So it's to find aligning the interest of the policy-driven public investors, where they would want to maximize the impact in terms of, for example, geographical coverage and leverage, which in this particular case would indirectly lead in maximizing the number of house passed. And on the other side, private investor prioritizing profitability and making sure that the mandate is really focusing on profit maximization rather than taking purely political decision. So this required a careful design of the fund governance and the fiduciary mandate. Next slide, please. On one hand, the independence of the governance body, notably the investment committee of the board director, was important to reassure the private investor. And on the other hand, the public investor, to comply with their internal rules, they also had to negotiate with the fund manager more thorough reporting requirements. Next slide. The creation of the fund was longer than expected. So the preliminary agreement between the Commission and the EIB was achieved, I would say, end of 2016. Launch of expression of interest was in the spring. Sorry, the agreement was end of 2015. the expression of interest in spring 2016, and the appointment of the fund manager took about 1 year. So that was already 1 year in the process. But then we had another year for the finalization of the fund documentation and reaching the first close of the fund. The more complex point of the negotiations were finding an agreement on the cash waterfall and determining how the principles of the first loss would actually materialize in practice. So until which level, how this would be counterbalanced later on. Also, another important aspect of these negotiations was to make the fund market conform. This was important to ensure that, that the fund would be free of the need to submit a state aid notification each time it made an investment. So to make sure that the public investments would be neutralized or considered as compatible with the state aid regulation. DG Comp made a number of requests to ensure that the Commission invested pari passu, or at the same conditions as private investors, and also that there was a minimum share of such private investors to have a benchmark within the fund. And another criteria was that the risk-return distribution was coherent across the various layers of the fund. In particular, that if the fund was very successful, the first loss and the Commission in particular had the highest return because it took the highest risk in the first place. Next slide, please. The first closing, as I mentioned, took place in June 2018. It reached 420 millions, almost exclusively from public sector institutions, or let's say also including national promotional banks and institutions. Because of the uniqueness of the platform, so single sector, greenfield only, and also the multi-layer structure with the public sector, it was challenging to do a regular fundraising. It took more time than anticipated to convince the private investor and explain all these novelties. It indeed took 3 years to increase the commitments of the private investors to actually reach over 160 millions, which is at the end of the day something very high. It took a long time, but a share of 30% from private investor was a big success and a record for centrally managed financial instruments, especially because it was an equity fund on a very narrow investment strategy. I will still take 1 minute to do a conclusion with the next slide. So representative from Cube will tell more about the operational outcomes, especially in terms of house pass. Here we'll really focus on the efficiency of as a tool from the European Commission perspective. So when we look at the leverage, the impact that is achieved with the EU budget and the commitment that is the amount of investment that is actually attracted to projects of European interest and of public interest, the leverage of the CEF investment, which was of 100 million, was 5.5 times, 5.5 times at the fund level. And then when we look at the project level, including, well, it's actually a bit premature because the project is still developing, but it is expected to reach, also including the loans that this project will include, something close to 9 times what was initially invested by the CEF, considering that traditional co-funding rates from CEF range between 30 to 50%, with peaks of 75% of the costs. The equivalent of CEBF corresponds to something in the range between 10 and 15%. And the best fund is that these amounts will actually be reimbursed. And this is the revolving nature of these tools. And in the most positive scenarios, there is also a profit that will be made on this investment. I think that here, something that we heard before, infrastructure funds are for patient investors, and that's also something that maybe policy players maybe are not very used to, or maybe very keen on. We have to be patient again to see if what will be the actual return, or let's say actual co-investment, and if there will be a profit. But that's something very, very interesting. The leverage that was achieved, it's outstanding. Another important aspect that I think is usually less commonly discussed when talking about financial instrument is that the driver, especially when we have market terms and large participation of private investors, is that the driver is really profit maximization, and therefore careful management and control of costs. This implementation mode is therefore more efficient in capital expenditure in our specific case in terms of house passed by fiber. The actual costs in comparison to programs that look at just reimbursing costs, the traditional grants, is much more efficient. So looking back at our starting point, where we have a certain amount of investment needs to achieve the targets, not only these needs can be covered with a different share of public and private according to different leverage effect, but using financial instruments and putting the focus really on profit maximization will help a lot in actually keeping the investment needs as low as possible and actually reducing the gap that is needed, that is there in the first place. This is concluding my presentation. Thank you very much. The floor is back to you, Kelly, and to the next speakers.
Thank you so much, Julien. Very nice and clear presentation. I think we can now move on to the next part of the CEBF presentation, which will be presented by Natalia Soutouguina and Mustafa Demir. So I think I leave the floor to Natalia first, right, Natalia? So the floor is yours.
Thank you, Raquel. Thank you, Julien. And so now it's time to see how the creative approach suggested by the European Commission for the fund structuring turned out into reality. So I will be speaking about mostly CEBF, the Connecting Europe Broadband Fund, but let's start first with the manager of that fund, the Cube infrastructure managers. Who are they, and what is their positioning? So let's take a look at this slide. As you can see, this fund manager is focusing on the European mid-market infrastructure investments, and these investments is basically in the alternative asset class that has seen, infrastructure has seen significant growth over the last 10 years, driven primarily by infrastructure renewal, digitalization, focus on sustainability, and energy transition. So in Cube, we have managed to raise so far 4.3 billion of capital across, this counts all of the four funds. Cube 1 Cube 2, Cube 3 are the flagship funds. Cube 1 has been already fully exited, and Cube 2 and Cube 3 are the active funds within the brownfield universe. And CEBF is the one that is in the greenfield area with committed capital of 555 million. So Cube overall was created in 2007, and now it counts already 18 years of infrastructure experience. As I said, today we're managing 3 billion across Cube 1, Cube 2, Cube 3, and the CEBF platforms. The brownfields are focusing on 3 sectors, which is energy transition, digital infrastructure, transport, and environment. And the CEBF fund is solely a niche player within the digital infrastructure segment, focusing on underserved geographies within the EU, specializing on fiber to the home open access networks. And to manage this fund, we have a dedicated team. Overall, within Cube, there is more than 60 professionals across 2 offices, one in Luxembourg and one in Paris. And for the CEBF fund, we have a team of 8 dedicated professionals. So let's look at the next slide, whereby I would be able to present to you a little bit more on the track record of Cube and CEBF in telecoms. As you can see from here, we have had 18 investments in Europe in the telco space. We have covered quite a wide range of geographies. So these 18 assets were across 17 countries. Cube's telecom portfolio lists data centers, IoT networks, and of course the fiber networks, which is the core focus of CEBF. Cube's experience in fiber to the home dates back to 2011 with the investment in Covage, which is an open access network in France. And then we went to DS Telecom in 2018, which is an FTTH network in Portugal. That is the same year of the vintage of the CEBF fund. So with CEBF's monosectoral approach, our overall portfolio at Cube is very much skewed towards FTTH. Actually, from all of these assets, you'll remark that 2/3 of the participations are in FTTH, making us a uniquely positioned player in this space. We have accumulated tremendous experience across multiple geographies in the sector, and we believe we are a true contributor to Europe's digital goals with a focus on, as I said, rural and semi-rural areas. So now I pass on to Mustafa to expand on how CEBF was started.
Thank you, Natalia. Maybe we can switch to the next slide. All right. So as Julian mentioned, there is this overarching purpose to bridge private and public investor and stakeholder purposes in this fund. But the overall vision was to enable high quality, affordable, reliable digital connectivity to underserved geographies in the EU. We had to bring in private and public interest together, and we have to be able to provide investment opportunities and invest in situations whereby both parties are happy. In terms of a time perspective, to achieve these goals, in 2016, through a beauty contest public tender process, the Cube infrastructure managers have been selected. It was a widely anticipated and participated process. There were 10 infrastructure managers participating in this process. And as a result of the evaluation, Cube Infrastructure Managers, a Luxembourg-based alternative investments fund, have won to execute this mandate. I mean, in the end, I think it is very important to highlight again the potential difficulties in bringing together public and policy goals and private investor priorities. So as a result, there was this fully independent manager, which is going to decide to serve its shareholders and to make sure that its investments are profitable. I mean, as I mentioned, the purpose of the fund just enable high quality, reliable connectivity to underserved areas in the EU is a very, very grand objective. But in order to be able to execute this objective and also satisfy private investor demands with a very limited ticket size, which at that time 30 million euros, and a lot of diversity conditions. So we had to invest in several countries and several situations. We had to focus and we had to hone our strategy. So as a result, we have come up with the mission of this fund, to which we summarize here. We decided that we're going to invest in greenfield open access fiber networks in semi-rural and rural areas. And when I say open access, is basically these situations are going to be open to all participants. They are not going to be captive situations, and we are going to be investing in greenfield ones. So the capital deployment, it takes time. Just to give you an example, to pass a home in certain geographies in rural, it can be more than like 3,000, 4,000 euros, and it can take a lot of time. For example, in Finland, you can only build in like 4 or 5 months of the year, and it is a very challenging, execution-wise challenging mission. So maybe we can switch to the next slide, so I can give you a perspective in terms of timing what we have done. So in 2016, there was the awarding of the manager, which is Cube Infrastructure Managers. So in 2018, we have done the first close, and in the first close, it was all public investors, but one private investor. So this one private investor made this fund a reality, to be honest, because public investors in the end said, okay, we are happy to support you, but you need to bring in other investors and other money and private money to make this a reality. So we managed to bring in one private investor in the first close, and we started investing. Then in 2020, in 2021, we have been hit by COVID, as you know. But I mean, this investment process has been very challenging. Apart from the situations like COVID, we had to study like more than 200 investment proposals from different geographies, and we have basically worked with very, very different stakeholders in order to achieve this investment projection. We have made 10 investments, including the time in COVID and the financial calibration of interest rates, whereby basically in starting in March 22, there was this period of rates in interest rate hike, which made the investment environment very challenging. We have exited 3 of them. We have 7 investments. So far, we have committed almost all of the fund, which is 555 million euros, and we have deployed almost 60% of the fund. So this is a great achievement. And now I will pass on to Natalia to tell you where we ended up and where we wanted in terms of CEBF.
Thank you, Raquel. Next slide. Thank you. So here we go into the in-depth from theory to reality of the CEBF fund. As Mustafa mentioned, the original ambition of the fund, which is set out in the private placement memorandum, founding legal document that covers the guiding principles of our investment strategy, envisaged that we would spread out our capital as widely as possible. So these 555 million would be dedicated to investments in 20 projects across 12 countries. We would be aiming to be a minority investor with a ticket size of 1 to 30 million. So those funds, the 555, were supposed to be leveraged through co-investments and external financings in order to have this multiplication effect of, I don't know, at least 3 times. And so currently, what happened, the reality was a bit different. And as Mustafa said, we now have, at the peak of the fund, we had 10 investments in 8 countries. Now it is even more consolidated towards 4 platforms across 5 countries. And the CEBF fund is a significant majority investor in all of our participations, with a ticket size of around 50 million. And you can see that there was quite a bit of an extension to the ticket size. So why did that happen? Well, first of all, the greenfield nature of these projects and the high risk profile of these projects has not converted into interest, or at least in the early days, of other co-investors joining in. Plus, the projects took more time and more funding in order to get them off the ground. So which actually made it for us to expand the ticket further and become a significant majority investor in these projects. Now, if we look at the bottom of this slide, here you can see on the left-hand side our current portfolio snapshot. As you see, our assets are distributed, as I mentioned, into 4 platforms. For us, a platform is a holding company that consolidates 1 or more operating companies under its holding in relevant geographies. And so, as you see, our Spanish, for example, platform represents currently 56% of our portfolio. This is based only on the development status of the network, meaning that the Spanish assets rollout of the network is far more advanced, because this counts the number of homes passed in the overall portfolio. And then Finland here is at 1%. It's just to say that it is the youngest of our projects, and it is currently in the ramp-up phase. And on the right-hand side, you see the deployment evolution of our fund. As already mentioned several times, we started in 2018, and as you've seen, with the COVID, it took us longer than expected to ramp up, to get our assets off the ground. So you see that in 2020, there was very little to show for that progress. However, today we are already hitting 50% of our rollout targets for the overall portfolio. And as we aim to complete our rollout strategy, we want to conclude on our portfolio with 1.8 million of homes passed. Now, next slide, please. So let's speak about our lessons learned as we have launched numerous FTTH projects from ground zero across multiple geographies. And although, of course, all of the cases were unique, there were some recurring things that we would like to share. The first one is the lengthy development cycle of such projects. Despite having very experienced professionals as part of our management teams, complemented by senior advisors at the level of the fund, we've seen that there were numerous delays. And the main complexities were related to permitting processes and onboarding of ISPs, with contractual work, with technical integration and commercialization taking more time than anticipated. So that, of course, increased the running costs of these projects, and we had to adapt our budget to stretch the limited equity resources. Then the second point is scale and the significance of a minimum scale of the network in order to advance in the commercialization of our assets. National ISPs look for a certain minimum size of the assets in their decisions to allocate resources, both for technical and integration and the commercial efforts, to make it economical for them. So small networks, even if relevant ones, do not reach top priority of such ISPs. So that again delays the revenue generation profile of such assets, and hence again the need for patient capital. The third point is competitive dynamic, that despite market studies that we have performed before investing in each and every of our projects, the transition to fiber has been slower than projected. There are numerous factors for which account for this, with the enforceability of the digital transition policy being weak on the local levels and the incumbents sweating the copper assets and consumer demand falling below our original expectations. So again, it takes time, and it is absolutely essential to have available resources to bridge these lengthy periods. And finally, we want to again underline the funding point. The original premise of the CEBF fund relied on the assumptions that we would be a minority investor in the project, and that the external resources would become available once the projects become operational. However, given the monetization, the low monetization visibility at these early stages and the longer timelines, especially exacerbated by COVID, the risk-return profile of such projects were unattractive for institutional investors and too small for the industrials. So again, here we were relying predominantly on our own equity to develop our young assets, seeing limited alternatives for such source of financing. I want to also say that it was important to have flexibility on the part of our LPs, given that we had to a little bit adjust our approach and our strategy in order to be able to ideally position our assets for success. And to conclude on this slide, of course, there's this question if there is a need for funds such as CEBF, and our response is absolutely. CEBF's equity was key to fill the funding gap for early stage fiber to the home projects. Again, fiber to the home, it's a critical and future-proof technology which drives economic growth and competitiveness and fills the digital gap. And through this layered approach that we've talked about, the public funding was complemented by private funding, making it a win-win situation. And now I pass on to Mustafa also to expand on our experience and how we commented through this experience to the white paper on how to master Europe's digital infrastructure needs.
Thank you, Natalia. So, I mean, in February 2024, the Commission issued the white paper, How to Master Europe's Digital Infrastructure Needs, and asked the market participants to comment. I mean, everybody basically was free to comment on this white paper. And as Connecting Europe Broadband Fund, we thought it is our almost duty to participate in this process and share our experience and proposals very openly, publicly to the Commission. With this slide, we would like to summarize our public commentary on this proposal. We believe this is extremely important for us. We have accumulated a lot of experience in rolling out next generation connectivity infrastructure in Europe, which we believe is key, and it will be used for centuries forward. Just to give you an example, the existing copper networks in Europe was started to be rolled out in 1880s, and the copper networks like fully covered European territory in around 50s. So it took like 70 years of infrastructure investments. And the first fiber investments, which is a future-proof connectivity solution, started in Europe in 1990s, and so we are expecting that it's going to be finalized around 2025 and 2030. So it's going to take 35 years. But don't forget, this is a future-proof investment. You're doing optical transmission. You can transport large amounts of, very, very large amounts of data with very low latency and loss. So this is extremely critical for the improvement, development of the continent as a whole, and it will be the backbone of digital transformation and efficiency, and hopefully provide a lot of benefits to its people. So our first proposal point was basically telling the policymakers and everybody, just we need to work together to accelerate copper network decommissioning. We have been, Julian has been saying, and I think the policy is actually called connectivity, and connecting to what Julian has said. He was saying we have a target now by 2030. We are going to have gigabit enabled networks in all of Europe covered, basically. So okay, I would like to add one thing. We would like to add one thing to this. You don't want it to be covered only. We want it to be connected as well. So in order to enable this connectivity, the existing copper network needs to be decommissioned. The existing copper networks are inefficient. They are not environment friendly. They are almost obsolete. But especially the incumbents right now, they are very happy to use them. Not all of them, but many of them, because these are all fully depreciated. They make money on these, and they don't want to give up this privilege. So it is absolutely critical. The Commission, the policymakers, they come up with one policy saying, you know what, this is the deadline, 2025 or 2030. We are going to decommission the copper network. So everybody should prepare for that. I think this is extremely important. And we fully encourage the Commission, the policymakers, to set a deadline as such, and pursue this purpose as vigorously as possible. Second point is basically we want the policymakers to enhance regulatory frameworks to rein in the incumbents in opening up their infrastructure. This is extremely important. Because if you have incumbents who own the legacy infrastructure, and if they don't open up that infrastructure to market participants, then the private investors or independent investors like us, they cannot really provide services to others. So this needs to be more rigorously and more carefully executed all over Europe with no exception. And the third point is, I think this is a financial point. The regulators, maybe banking regulator, needs to provide a bit of comfort to private investors like insurance companies or banks to be able to invest in greenfield infrastructure, because we believe greenfield infrastructure is the one that creates long-term value, and it is definitely best positioned to provide the best return for the whole society. So we believe the regulator needs to enable the capital holders like banks and insurance companies in terms of their capital requirements to give them an incentive or comfort to invest in greenfield infrastructure situations. The fourth point is that we need to enforce the more efficient use of existing infrastructure so we can decrease the capex. I think this is extremely clear and extremely straightforward, but we believe it is extremely important again to highlight. And the fifth point, and maybe this might look a bit technical, but the first thing that you hear from market participants, especially the telecom players in all over the world, they say that we have our systems proprietary. So we created our software, we have created our APIs. That's great. They say these things as if it is something like extremely valuable. But I mean, in a capital expensive sector like telecoms, it is important to create efficiency, and you can only create efficiency if market participants can use each other's resources freely and easily. So I mean, creating your own APIs, creating your own technology is very nice, very good, but you need to make sure that there are like certain standards so everybody can use them and profit from them. So we believe it is important, very important, again, for the policymaker to tell the market participants, telecom companies, and all of them, they should open up their APIs and standardize their APIs, for example. And finally, there should be promotions to network take-up in rural areas, because these are neglected. I mean, most of the urban areas where most of us live, we have multiple networks already covered, but in rural areas, we don't have enough networks. The reason is basically demand is slow, and you can only promote the demand, and you can accelerate the decommissioning of copper networks, and hence improve the overall connectivity in the continent. So these are our proposals. We have shared with the Commission, we are shared with everyone, and we strongly stand behind these proposals and advocate for them. And we are very happy to be part of Connecting Europe Broadband Fund, contributing the rural connectivity of Europe, and also share our views with you. Thank you very much.
Thank you so much, Mustafa and Natalia. So this really finishes the presentation round. So I guess we can now move on to the questions we have. We received 3 in total, and I think they are divided between Julien and the both of you. So I will start with the question that I believe is for Julien. What are the general returns of these pioneer funds? Julien, if you can maybe answer this one.
That's unfortunately, I don't think I have the information. In many cases, as I mentioned before, especially the infrastructure ones, which I am a bit closer, they tend to be long term, and the exit is not always already for the equity investment is not always already concluded, and in some cases some of these funds are also without. I think, for example, the energy efficiency fund is an evergreen fund, so meaning there is no formal end, meaning that the fund will continue lending each time that they get a loan reimbursed, they will continue. So also in that case, it's possible to get a snapshot at a given time, but we don't have the return will continue to change because the activities are not over. I would say that most of the cases we don't have yet this information. And I'm thinking about the annual discharge that is given to the European Parliament. It is including a financial reporting for all the financial instruments of the directly managed financial instruments, shared central financial instrument. I think that the internal rate of return is not one of the KPIs, so I don't have this information ready to provide for you. Sorry.
Maybe Raquel, on this one, I could add that we have provided in our slide some indications as to what CEBF is targeting, and CEBF is targeting market standard returns with low teen IRRs.
Okay. No one else wants to add anything? Mustafa, no one? No?
No, I mean, maybe like very quickly. So these are a few important things, but I think this is important. Is like patience is important. There's a J curve in these investments, which means this is a continuous capital deployment. It is like you're building you're constructing the building, and while on halfway it looks like very ugly, right? It might not be very beautiful, etc. But once it's built, it creates wonders. So this is a continuous capital deployment. This is very different than other situations. So it requires patience. At the present, it might not be very attractive, but in the long term, they are extremely attractive, very strong cash flow generating assets, and 10 to 15% return in such situations is extremely attractive. I mean, don't forget, we are now living in very high inflation. I mean, now it's lower, but now we are living in very high interest rate. But I mean, for like 30 years, this continent or most of Europe has lived with around like 2%, maybe 1.5% interest rate. So we should recognize the risk-free rates and long-term value of these assets, having a look at that perspective as well.
Very good, thank you. I will ask the second question to the three of you so that you can all contribute if necessary. So the person says, do I understand correctly that the EU is taking the place of junior funding, that it takes all losses first, ensuring security to more senior private investors? Who wants to start? Julien, okay.
That's exactly what it is. When the waterfall, the cash waterfall, it's exactly giving a priority to who gets the money first. And the money is going first to the senior, and if there is money left, it's going to the mezzanine, and if there is money left, it goes to the junior. In this case, it is the commission. So if there are not enough, it stops before. That's the functioning of the layers.
Great. Nobody wants to add anything to this one? No? Okay. Then the last, third and last question of the day before we wrap up, because we are running a bit late. So the CEBF reality looks quite sobering in terms of leveraging, mobilizing private capital. What are the lessons learned for future similar endeavors? I guess Natalia and Mustafa, this one would be for you.
Well, I think that for endeavors, I will leave it to Julien, but I just want to say again, indeed, it is sobering. Nevertheless, the ambition is still to leverage these funds. It's just that the timing will be not as originally envisaged, whereby we were thinking that we would be already in the earlier stages being rather popular with the external financing, and that is just a question of being postponed. So that is still the intention, and as our assets, and specifically I can refer to our Spanish assets as they are the front runners, so to say, of this J curve, they are gaining traction with the external financing. We should be seeing that also for our other funds. It's just that it's taking longer.
Julian, do you want to come? Sorry, go.
Maybe I can complement Natalia, and then maybe Julian can figure. I mean, it is sobering. Yes, it's not easy. Yes, you are replacing 100 years old infrastructure, and in rural areas, you're doing things that the others are neglecting. Right? There are things that keeps you awake at night, but there are also things that make you wake up very early in the morning. We are focusing on the latter, right? For example, we are going to field trips and we are seeing like a small town of 500 villagers in Segovia or in Lazio or in Slovenia, and we see these people having the connection. And with our endeavors, these are the things that keeps us awake. And the investors are concerned. We understand this is their job to be concerned, and we are concerned also. This is our job to be concerned, but we are 100% committed and 100% confident that these are long-term investments. They're going to create value. You're going to see children, you're going to see teenagers, you're going to see like farmers using these networks, and they're going to contribute to the overall wealth of the continent. And private investors will make money out of them, and we will make sure that this pays off for all citizens of Europe.
Well, maybe on my side, I will actually take a kind of different approach in my reply, because of course the FTTH sector and market proved, especially in the rural areas, proved to be more challenging than we thought. But this is irrespective of the route that has been taken of doing an equity fund instead of doing grants. This wouldn't have changed at all. What changed is that we are actually still interested in these projects and how they face all their marketing challenges and all the trying to become profit making, breaking even, while we would have completely ignored everything after the expenditure after the reimbursement of the grant. From a traditional grant perspective, we would simply monitor the construction, ask for invoices, pay the co-funding rate agreed, and then left. Here we actually, so if they went bankrupt the day after, we probably wouldn't even have known. So now we are actually forced to stay closer to this project for a long time, and that's not necessarily something bad. I think that it's providing us a lot of insights in the sector. It's providing a lot of feedback for our policy reasoning and what is needed. So we're doing a consultation on the white paper that is, I think it's also good for us to be hands-on and see them. And I wouldn't necessarily say that there is anything bad in having this experience, that we are in this phase of the operational implementation of our investment, because it's providing also an added value that we wouldn't have had in comparison to a normal grant. But this is a very different perspective from what my colleagues from Cube has provided, which is really on the challenges of the sector. So I would say that if this is a sobering picture, it's not really related to the type of instruments.
Okay, great. Well, I think it's time to wrap up the session, as we really took more time than we had planned. So thank you so much for such a great session. Thank you to the speakers, to the audience, to the technical team, to my team, and everyone involved in this session. We had a bit more than 200 participants today, so great participation. As I said in the beginning, so the recording for this session will be available as of next week on the Digital EU channel on YouTube, and the slides on the Futurum platform. So if you missed a bit or a big part of this session, you can review it online later. Thank you so much. Wishing you a nice day and see you next time. Bye, everyone.
Thank you.